Hello, my friends. Ivan Oberon here, your favorite mortgage consultant with Prosperity Home Mortgage and real estate investor. I want to come to you again today in my efforts to help best equip you with knowledge and information to make the best possible decisions for yourselves and, of course, for your clients, the clients that we work on together. And a big topic right now is, should I wait and should I rent? And so we're going to be doing a little bit of a few different videos to break down a couple of these different things. And tonight I want to talk about the cost of waiting to buy. What is it actually going to cost? So you have the information and that's understandable, that you know what's going on and you can make the best decisions. So let's talk a little bit about, okay, well, what's the risk for waiting to buy? Is waiting a good decision? And what we're going to do in this short presentation is just talk about the actual historical property data, so you see some data on kind of where we're going, and of course talk about the relevant things of today's rate environment, pricing environment, and what's going on. So saddle up, let's get going, and that way you can make a good decision here down the road, or you can have good conversations with the clients that you're talking to. And there was a survey recently here in August that asked consumers whether or not they thought it was a good time to buy. And actually 66% of them said that it was a bad time to buy, which is kind of crazy, right? Because you've seen how crazy the market is, and multiple offers per property. And we're seeing some of that kind of taper off a little bit, but you're still seeing 20 plus offers on some properties. And then of course that's actually gone up from 64% a month ago. So why is that happening? And the prime buying groups are the ones that seem to be most primarily concerned, which is basically consumers between ages 35 and 44 with middle to higher income levels. So are they seeing something? Are they thinking long term in a different way than some of these other groups are? And let's get them some information too. And what's one of the things that a lot of people, especially here in California, it's not necessarily applicable everywhere else in the U.S., but in California, a lot of the reason that people buy is the hope for appreciation, right? We're one of the most appreciating markets in the entire U.S. That's why you see a huge appreciation over the years, sometimes very quickly, and that's why we also crashed as hard as we did back in 2008. Now, I don't foresee that ever happening again in that level, to that level or that degree, but that's one of the reasons that people buy is here in appreciation. And one of the things that drives that is, of course, demand. That's one of the things that, of course, is driving our prices as well. And we just aren't building enough homes for the people here. We have very diverse job sectors. So California continues to grow, our population continues to grow. And even though many people are leaving due to their own reasons, there's still a lot of people coming here and a lot of people coming into home ownership that have been living here. So really what happens is that they're saying that if we were to keep up with the demand, because we stopped building houses as quickly as we were for a long time, we'd have to build about 2.1 million homes each year for the next 10 years to make up the shortfall in demand for housing. So appreciation is always going to be pretty steady here in California, even if and when prices fall, you know they're going to come back. They just always do. And it seems to me that the last couple of times they've come back bigger and better than even before. So that's kind of wild. Now, here's a conversation that we need to start having a real talk about, because people still think that, well, we're in this super low interest rate environment, which we are. Okay, rates are still historically super low, just not as record lows like we did early on in January and March, where we were teetering in the low twos, 2.25, 2.125 wasn't too uncommon to be able to get a loan for in those low ranges. And then people had a wake up call, right? That's what happens when they started the vaccines, and then we had the Delta variant show up, and rates and after the vaccines came out, that's when the rates started kind of going up again, because consumer confidence and the government confidence improved. And so some of the activities that they were doing on the secondary markets, buying mortgage-backed securities and treasuries, kind of came down a little bit, and so interest rates started to go up. And the Delta variant came out, and so now we're starting to, oh shoot, we gotta keep these rates suppressed. So they started buying more of those as one of the driving factors of what happens to rates. And then, of course, then the jobs report came out, and they were thinking, man, this is great. Jobs are coming back. The economy is going to be back to normal. So rates started to fall, or to jump up a little bit. And we had another fall, and then we just had another rise, right? And for the first time, the Feds have announced that they will definitely be increasing rates by the end of the year into the beginning of next year. And now we could be seeing rates back up into the fours, which for me, still super low rates, super awesome rates. But compared to where we are and where we were, to see almost a 2-point increase in rates coming up here between the beginning of this year and beginning of next year, it's going to make a big difference. So there's a lot of stuff going on here in 2021 that's going to be shaken out. And so what does that actually mean? What does that look like? Well, again, don't be expecting rates to go back down. They're kind of like, they held steady for about 6 weeks, and then they jostled a little bit, and they came back up a little bit. And so now here's kind of like the new normal. Right? The new normal is the new watermark, if you will. So don't expect rates to go back down moving forward. So here's the nitty gritty. Here's where it really makes sense. So hopefully I made the rest of the stuff a little bit kind of interesting, but here's where the rubber meets the road, if you will, because this is going to show you the cost. Okay, this is what's costing you. We're going to talk about your buying power, which is important too. But what is it actually going to cost you on an average sales price of $1.6 million with 20% down, a loan amount of $1.28 million at a 3% interest rate, which is right around where it's hovering right now, 3 to 3.25, depending on the scenario. Though our jumbo rates are fantastic, we're still seeing a 2.875 to 3, depending on the scenario. Well, what is this going to look like if these rates start to tick up? You see here on the screen where it started at 2.875, and maybe we're going to end up above 4% after the beginning of the year. And if you look at this chart, you're seeing the amount of increased cost of interest is almost doubling from the first rate to the next rate and so forth. And if you were to go, and that's just over the course of 10 years, you can see what it would cost you just to have a slight increase in your rate as you go up the chart. Also, the buyer's appreciation is another thing to consider. So that's the other side, is that what if appreciation, the values go up? So that's kind of where you offset some of those things. But you're gonna lose equity in that appreciation with a higher interest rate, right? Because it's sucking up more of the profit of the property. All right, now what is it going to do to your buying power? Let's just start at a simple $600,000 home where we were at 2.5%. Now we're teetering closer to 3. That diminished your buying power by like $70,000. Right? You go from about $950, what you could afford, all other factors being equal, to about $890. So that's a big drop. If just another 3.5, you drop down to $835, $785 at 4%, and so on. So you can see the dramatic difference it's going to have not only in your expenses but in your buying power as you wait. So if you're on the fence, right now is a great time to buy. It's still a great time to buy. It's better now than it will be in the future. And here's one thing that I know some people are thinking. Well, as interest rates go up, well, property values will come down, so I'll still be able to get the same kind of house. And I'm going to caution you that interest rates will rise at a much faster pace than the market will adjust for pricing. Okay, that's going to take quite a while. You couldn't tell you how long, but if it doesn't take more than a year to have an offset that's significant enough to wipe out the increased rate, I'd be surprised. So hopefully that makes sense. I kept this brief enough for you to give you some valuable information to take out there, make decisions, to have intelligent conversations with your clients and your loved ones who are considering buying and or also potentially refinancing their homes. Because pretty soon, if you have a rate that's about 3.5% or higher, right now it's still a good time to consider refinancing. If that's where you are and you wait another few months or to next year, that window is gonna close, and it's not gonna make sense for you anymore. You can always reach me at 805-236-2647. I'm here for you. I appreciate you. Until next time, talk to you soon.